Hello everyone and welcome to this new venture, which is a monthly, more or less, podcast that we expect to present to you. My name is Mr Lacalle and I'm an economist. I'm the author of The Energy World is Flat, Escape from the Central Bank Trap and Life in the Financial Markets. You can follow me on Twitter and you can follow us as well in this podcast that we expect to make it a dialogue that we will have from time to time. What shall we talk about this time? To start with, we need to talk about the global slowdown. Many commentators, consensus, etc. started last year with a perception that what we would have in 2018 and 2019 was synchronized growth. And synchronized growth was a complete fallacy. Synchronized growth was, in fact, just the dream of central planners of thinking that every single economy, or almost every single economy, can do more or less the same. The developed markets grow a little bit less, and the emerging markets a little bit more, but more or less in tandem. Obviously, that was a complete fabrication, and what it has led to is the reality. What is the reality? The reality is simply synchronized debt growth. Global debt has reached an absolute record of more than 300% of global GDP. And that massive increase in debt was looking to get some leverage to that higher growth. However, we started with emerging markets. Emerging markets started to show the reality of what emerging markets always show, which is that their illness, their difficulties, their challenges bursts through currencies. And currencies started to fall because in the past 5 years, particularly in the past two, emerging markets have grown accustomed to the view that there would be no problem in raising fiscal and trade deficits at the same time, while taking massive imbalances and taking more debt, particularly in dollars. Debt in dollars from emerging markets rose dramatically in the last 2 years, achieving a level that was not seen relative to total debt in many, many years. And that obviously was predicated on the idea that the dollar would continue to be weak almost forever, and additionally that interest rates would never rise, and interest rates do rise. And spreads are rising. Why are spreads rising? Because the reality of growth is weaker, because the reality of debt is higher, and also because the idea that the US, the European Union, China, and emerging markets would all deliver above trend growth was simply impossible. We have seen in Japan that after massive stimulus, 70 billion a month of asset purchases, in the third quarter, the economy is shrinking. And obviously, consensus will always say that this is because of temporary factors. We have been hearing the same in Europe in the last 4 quarters. We have been hearing that the Eurozone slowdown is a temporary factor. It's so temporary, it's been ongoing for almost a year now, and it's pretty evident in also the shrinking German economy. And the shrinking German economy, the shrinking Japanese economy are the evidence of the saturation of debt, and also the evidence of the fallacy of global trade growth rapidly rising. It's not a question of trade wars between the US and China, it's a question of excess of demand-side policies. Demand-side policies that have basically driven countries to raise their overcapacity internally and try to export it out, while at the same time other countries did the same, ended up with China achieving almost a 40% overcapacity, massive levels of debt, and trying to export it all out to the United States. Now, what ends up happening is that if everybody wants to sell to the same country, obviously that country is going to dictate the terms. What ends up happening, in any case, is that we have massive global imbalances based on the domino effect of trying to pass those imbalances of each of the economies into the US or into China. China, on one side, is devaluing the yuan. While it devalues the yuan, it is exporting deflation to the rest of the world. The US dollar, on the other side, is strengthening, but it is not strengthening because of US policies. It is strengthening because of the weakness of other currencies. The euro is weakening. The emerging market currencies have been weakening. Therefore, we are not seeing an environment in which the dollar strengthens because the economy is booming. We have seen deficits rising. There's a moderation in capex, moderation in growth into the fourth quarter. So what we are actually seeing is a risk-off environment, precisely because the evidence of debt saturation is more and more clear. And if we look into the next months, we need to count on three factors if we think that global markets are going to bounce back. The first factor is macro. If rating agencies like Moody's or international agencies like the International Monetary Fund are consistently reducing their expectations of growth for 2019, it's not because they're too conservative, it's because they were too optimistic. And more importantly, it is not that they have gone too far in their reductions of growth estimates, it's that they are going too slow. So we are likely to see further downgrades of growth expectations, both in developed markets, particularly in the Eurozone, Japan, and also, more importantly, in the allegedly high growth emerging markets, and China as well. Second, earnings and multiples. The markets have been used to massive multiple inflation because of monetary policy. Monetary policy has been extremely accommodative, and as such, when interest rates are so low and there's so much liquidity, the multiples, the valuations of fixed income, equities, private equity, everything goes through the roof. What ends up happening with that is that once the debt saturation process starts, what we see is that it's very difficult to discern real value. Why? Because on one side, earnings momentum is coming down, growth momentum is coming down, fiscal deficits are very sticky, very sticky. Most countries in the world next year are going to be increasing their deficits from the previous estimates. While that exuberance in terms of valuation starts to face the reality of slowdown. So we need to be very, very cautious, particularly about cyclicals and particularly about those sectors or assets that need higher growth and better inflation in order to rise in value. Commodities are showing the disinflationary effect of the yuan devaluation, of the slowdown in China, and the global slowdown. Iron ore, copper, gold, even oil are showing that there was probably a little bit too optimistic views about growth. Third factor is the monetary factor. It is not a question of whether central banks are going to continue to be accommodative. Of course they will be. Of course they will be. They will continue to have very aggressive monetary policies. The European Central Bank might prolong its stimulus package. The Bank of Japan continues its never-ending stimulus. It continues forever stimulus. The PBOC in China is also doing the same. However, the placebo effect that generates on financial assets and on expectations of growth and on the desire to take more credit, that is fading away. And it's already fading away in Japan, it's already fading away in China, and it's very evidently fading away in Europe. Therefore, we cannot count on central banks being, as they will be, accommodative for asset price inflation. What we need to count is on better margins, better growth, and better disposable income, reduction of debt. Very difficult to look at those factors. But we will continue to monitor them. So thank you very much for watching, and see you soon.